Good afternoon, everyone. Hope everyone's good. Good afternoon, guys. We did our last class on 13th November, right? Am I right? Last Saturday? No, Sunday. Is it? Right now we did on 13th November, right? Last time. Just confirming the class. So, guys, I had given you a homework. How many of you did? Got a feedback from Soumitra that many of you have not done. Who all did it? What about others? Abhishek, Fenil, you were not there on the last class. Prerna, Rajdeep, okay. Sakshi, Rishabh, done. Okay, fine. I think most of you have done it. What about Abhishek, Fenil? I think you were there last class. I couldn't recollect. Okay, so what was the answer that you got? What answer that you got? Balancing figure. What's the balancing figure did you get? This was the homework, right? Different figures. 3198 was already there last class. Now what we did is just we added our PP schedule, right? This schedule that we added. Yeah. So what was our capex? 10 million. Our capex was 10 million, right? And we had taken a useful life of 20 years. Which was 10, and we had taken as a useful life was 20 years. So efficient would have been 5 years, right? Answer would have been, so depreciation, you got this 5, 1, 10, and then net PP would have been this. So net PP would have been reflected over here, right? This was the change. Net PP changed. Then your PNL changed. And here also you need to change. This goes now equal to now, this is an outflow. Okay. So an outflow, you get a difference of 510. Then depreciation you link. Just doing that since everyone has done it, I'm just seeing what's the answer. So this. Then do you add back depreciation in your cash flow? This is what answer you got. Which one? 311 or 319? You got. I got this 31722. Did I do anything differently? What is the depreciation that you got? We did not add the additional capital again. Okay, what will we do? Acha, okay, fine. No, there's no additional topics over here. Acha, this one. Sorry, right. I just added over here. Yeah, 31728. This one still the answer is what is 5 lakhs? But depreciation, yeah, sorry. Depreciation is 5 lakhs. Then what changed? This changed. This will be 9 lakh 50. Why is there a different answer? 3118. Why I'm getting. Dividends paid also change. If you have not linked that, the dividends paid also changed because your PAT changed. You see? 3118800. If you have not linked that, now it will. Now it is 1,32,000. It was before adding capex. If I don't add capex, why it is coming 192 for me? What is the profit then? The profit is 192. What profit you got? You guys got? Focus dividend 10%, right? Everything is linked. Oh. Oh, sorry, my sales have changed. Sorry. It's fine. Okay, sales were 1 lakh. Sorry, I had changed that. Okay. Fine, so it should match. V1, okay, right. See, as long as it's telling, it's fine. Okay, so whatever numbers change, that is important. Once this is, if you know this, your modeling is done. I mean, majority of the things you know. Now let's go ahead and let's start forecasting. We have done it for 1 year. And you guys tell me how to forecast. Now next year it will be. You guys just help me forecasting. I say next year my revenue becomes let's say it becomes 7 million. Okay. Again forecasting. Acha, if I say my revenue grew by 30%, how can I say that? My revenue grew by 30%. How can I do that? I'm estimating that next year my revenue grew by 30%. Here, what can I take as, So what will be growth of 30% on 5 million? Can you tell me? Yeah, from last year it increased to, from 5 million it became, so 5, how many from 15 million? It's a 30% growth, okay. 1.5, yeah, 1.5. So it is 6.5 million. So here, how can I do that? I can write it over here at 30%. See what I'm doing. I'm writing over here 30%. Okay. This is my assumption. Okay? This is my assumption. I'm assuming my next year, my growth, growth means my revenue will increase by 30%. Yeah, right. So what I can do is 5 million, I can link this into open bracket. When I say growth is 1 plus 30%. And then I close my bracket. So see, I got 6.5 million. What I got is 6.5 million. Okay. This I can change. See, when I change numbers over here, it can change anything what I want. See, and just change to numbers, whatever numbers I want. And this is my first assumption for forecasting. Okay. Now, second assumption for forecasting, see, I had taken from over here, from inventory scale, my cost of goods. Now, ideally, what happened? You don't get this schedule. You don't get this schedule ideally because inventory schedule now, how much is purchased, how much is sold, you don't get it practically. If you look at annual report, you don't get that number.
So inventories are assumed. So we'll do today how the inventories are assumed. But let me rather than, so we don't have to create this schedule. This was just I showed you, how does it work? How does the balance accounts work? That is why I've showed you this. But we only get this 1 million number. Okay. So now how will you assume cost of goods for next year? How we assume is that, see, I know that from last year, my cost was 40% of my sales. So next year also I assume my cost should be 40% of sales. If I assume my cost is 40% of sales, what is my cost number? I assume from last year. Okay. From last year, I assume my cost is 40. So what will be my cost this year?
2.8.
That will be 6.5 million into the 40%. See, I am not punching anything. I am only punching the numbers which I want. What I'm doing, I'm just punching the numbers. Rest all is coming from a formula or from a linkages. Okay, I have to only punch my assumptions. These are all my assumptions. Now gross profit. Now last year, gross profit will be what? 6.5 divided minus this. So I get my gross profit for next year. I can find my gross margin. Now my gross margin is same. It will be 60% only. Since my cost, if I change over here, let's say I change my cost to 45. See, my margin changes. Okay. Now employee cost. Okay. Now employee cost, I say that employee cost and other expenses. There are two things that we need to assume. Employee cost, can I say it as a percentage of sales? Can I say that? Is employee cost as a percentage of sales? Do your salary increase or decreases with the company's sales? Does your salary decreases? No, if your sales of the company decreases, your salary decreases? No, the person we are just taking randomly because it's a dummy numbers. Now we will tell you when we do numbers on live companies. I'm just taking random assumptions. Okay. We are just now making a model, a dummy model, where how the assumption works. Now, after that you will find assumptions. Then it is your own research how you find assumptions. Okay. No, right. So this salaries cannot be. It doesn't relate to. Sales increase by 30%, Tamanna, and then this is increase. This is a growth, year-on-year growth. I am assuming a growth of 30% from last year. So what I do is 1 plus the 30%, and then this is as a percentage of sales. This cost is a percentage of sales. So I am assuming that my cost is 45% for next year. So my cost will be 6.5 million into the 45%. In India, usually the salary, again, same thing. If I say the growth, I am taking again a year-on-year growth on my salary. Now, assuming that in India, usually the salary growth happens 8 to 7% increment. If you know, there's 7 to 8% increment, or usually 10% increment in the salary every year. According to the inflation, India inflation is around 7%, so salary increases by 7%. Now, what will be my salary next year? I got an increment of 8%. I had a salary of 1 lakh. I got an increment of 8%. What will my salary next year? Tamanna, what will be my salary? What will be your salary if it increased by 8% next year? Yeah, it will be again 1 lakh into 1 plus 8%. Growth is always 8%, and this is percentage. Okay, remember this. Growth is 8%. This is again assumption. Okay, red is all my assumptions. Now next year. Now other costs. Now see, other expenses usually comprise of variable costs. Like marketing cost, traveling cost, then your electricity expenses, stationery expenses. So this many of the costs are directly related to sales. Majority of the cost and other expenses. So here we assume as a percentage of sales. So last year I assumed that my cost was, I calculated, my cost was 4%. So this year I also assume that, okay, I assume that this year my cost increased to 5%. Again, my assumption, okay, this is my assumption. Okay. Now other expense is 5% of sales. Now what it will be 6 million into 5%. Okay, these are my assumptions. Now, see, I can change the assumptions over here. I don't have to make any changes for the numbers. I just have to use these assumptions for my forecasting. Now, what is my operating profit or EBITDA? It will be gross profit minus employee expenses minus other expenses. Okay, what will be my percentage? EBITDA, can I find EBITDA margin? How do you find my EBITDA margin and EBIT margin? How to find? EBIT by sales, EBITDA by sales. So EBITDA by sales, this is my first margin. Second, okay. Now let's first. Now, whenever I talk about decimal percentage, sorry, it should be always one digit. You know, this is formatting. It should be one digit and it should be italic. Okay, always, because point plays a big part in percentage. Okay, in percentage, point plays a big part. If it becomes 5, then it shows 49. Okay, so always remember, numbers shouldn't be no decimals and numbers, and one decimal on all the this all your percentage figure. There should be one decimal and it should be in italic. Okay, that is how the formatting works. You know that these are different numbers, so all italic. Make sure you do this italic, all the numbers. Okay. It shows a different amount. This is presenting. Okay, now depreciation. Now, how will you find depreciation for next year? How do you find depreciation for next year? Here you have to assume. So this depreciation was coming from where? This has come from our. So this has come from a PPE schedule. Okay, straight line, that's fine. But now this is coming from a PPE schedule. Now let me this. Okay. What I assume is that, see, now there are two. Okay, there are two scales. This is one schedule. This is another schedule. Now in this is one schedule and this is another schedule. These are two schedules which we have made. So here same thing, closing becomes opening. Okay, right now this closing will become opening. Now this is also capex, I assume. Okay, next year I assume my capex will become 6 million. Okay, sold is 0. So now my closing will be what? Opening plus capex minus sold. Same thing as we did it for last year. So this is my total assets I have is 11 million this year. Again depreciation. Closing becomes opening. Now what will be depreciation for the year? What will be depreciation for the year? Can you find? I have a total assets of 11 million and I charge 10%. It won't be same. I have a total assets of 11 million, right? And I charge 10% depreciation. So closing is 10 million into 10%. Okay, so 10%. So my answer is 1.1 million. This is my total depreciation that I have charged. And then again my total till now I have charged how much? Till now I have charged total of 1.6 million on an assets of 11 million. So till now, so then you know, see 5.1 million from last year. Sorry, let me read this. 5 million from last year and 1.1 million this year.
So my total depreciation, so what is the net PP? My net PP will be closing minus, sorry, this closing minus this closing comes to 9.4 million. Now it goes to, where does this amount reflect now? Well, same thing, same thing what we did over here. I've just changed one item over here, that's it. This now, since this all is coming from linkages, you can directly, even copy this. So you just link this over here, and then you can just copy this, copy and paste. You will automatically get the answer. This also, since you have done it first, you just copy and paste it. Only just remember, closing should become opening. This is what you have to add additional. That's it. Where does this amount reflect? 9.4 million. Where does the amount reflect? Where does this amount reflect? In the balance sheet, asset side, PP. Okay, that is why we are making schedule. Okay, so we have found the assets for. So one asset we have already found. One balance sheet item for next year we have already found. Okay. Now, okay. Now let's start. Since we were finding depreciation, so we have got a depreciation. Okay. So let's start with our first schedule. That was our PP. That was our profit and loss. Now profit and loss schedule. Okay. What we got is depreciation. See now, since you have linked it from this, from here, I can just go and just copy and paste it. Control C, and just go and enter. I can get the same number. This is the number I require. Okay. Fine. Operating profit. My operating profit is what? I can just the bold items. I know that it was a calculation. Okay. That is why I had bold that, because for next year I can directly copy paste. EBIT margin. So now EBIT by sales 44 and 31. Now interest is 0. We have taken 0. Other income is 0. Okay. EBIT is this much. Now again, I take a tax rate of 30%. See the bold items now, I don't need to again do the multiplier minus because I have already done it once. I just have to copy and paste for next year. All the bold items, I don't need to copy paste. See now this is also coming from a formula from last year. I can just copy and paste. That is why the black items can be copy pasted. The red items you have to forecast. Only the red item you don't have to change. The rest all you can just copy paste. Once you have done one year, next year becomes very easy. I will tell you, after this 23, you can drag it till 27. I will show you once. Okay, now what is the PAT that I've got is 1429 is the PAT I got, 1.4 million. Where does the PAT reflect on the balance sheet? Where does the PAT reflect? Reserves and surplus. So we don't do it directly. We have made a schedule right over here. We had made a schedule for reserves. Where was it? Over here. Same way. This reserves closing becomes what? Opening. Closing becomes opening. Closing becomes opening. Then do I have the profit for the year? Do I have profit for the year? This will come from your P&L, right? This one. This is the profit that you have come, right? This is the profit that you have estimated for next year. Now I say my dividend payout ratio is 10%. I assume it's same. See, this is calculation. I can just copy and paste it. All thing I can just copy and paste it. See, I got the answer for next year. The next year my reserves will change to, am I right? Next year my reserve will change to this. Last year I had 1.3 million. This year I added 1.4 million. I subtracted dividends from this and I got this answer. Opening plus addition minus subtraction gives you this answer. Now where will this reflect? Now where will this reflect? Again in the balance sheet, because these are all closing figures. Now, inventory schedule we don't have to make. I will tell you. Let's go to others. See now, while preparing model, everything is coming from a schedule. So we have to start preparing schedules. Schedules are one of the important things while making model. If you don't make schedules now, you will confuse it on your own that what is exactly happening. This tells you that exactly what has happened from year to year. If you don't make schedules, your balance sheet, it will become difficult to tally your balance sheet. And from this schedule, the modeling becomes very easy. You know, this again closing becomes opening. So what I can do is I can just copy and paste. Closing becomes opening. Now let's say I have not raised, let's say I have buyback 60,000 of shares, 600. Okay. I'm assuming now I have buyback. Okay. My assumptions. I have buyback. So what will be my share capital next year? Okay, opening plus addition minus subtraction. Okay, this is our share capital next year. Okay. This is our share capital next year. Well, that's it. You have created. How many items are there on the balance sheet that we change? Other equity, equity share capital, other equity, land and property, inventory. Inventories will keep it same. I will let you know. And cash at bank. Okay. Now, cash at bank. This comes from where? The cash flow schedule. Now you guys tell me. Now, since I have raised equity, opening has become closing. Sorry, this closing I have linked it from over here. So what I do, I just copy and paste. This also I copy and paste because it is again coming from the schedule. Then land and property I copy paste. Okay, 23. Inventories I will keep it same. Okay, inventories I'm keeping it same. I'm not taking it because I have not made a schedule. Yeah, ESOP provided, then it increases. No, share capital increases. ESOPs are there. It is raised. ESOPs. You don't have to do it now, Manish. So that's very, many of them won't know this. So we'll keep it basic, okay? And cash balance. Yeah, that's what. Forget it. What is ESOPs? Okay. You see now my balance sheet is not tallying. If you see this over here, my balance sheet is not tallying. There is a difference. There is a difference. Okay. Now see this schedule is yet to be made, right? Because our bank account is next year a closing balance. It is not zero, right? It should be something next year. All the scales we have made. Now let's make our cash flow schedule. PAT. Now PAT has come from, this. PAT has come from over here. Depreciation has come. Purchase of inventory. Now this is okay. I will keep this zero. Okay. Purchase of inventory. I will keep this zero. Inventory per inventory. So I will keep it zero as of now because I have not assumed anything. Okay. Purchase of PP. What was my purchase of PP? You see, I'm just linking it. I can do it is equal to minus and link it from here also. But since I have linked it first only, I don't have to link it again. If you have linked your cash flows correctly, you don't have to link it again. Okay. Inventory sold. Okay. Now what is your cash flow from investing is this much. Okay. Now since I have sold purchase of PP, always make sure that you also do asset sold. Now always keep it linked. Though it is zero. So when you sell an asset, inflow, outflow. Sold an asset, inflow and outflow. Inflow, right? So what you do is equal to no, there's no negative sign. Now is equal to just make sure you just just link this. Though it is zero, but make sure you link it and make sure you have done this.
Now cash flow from financing. Okay. Now proceeds. Did you do any proceeds last year? So this year you didn't do. What you did is the buyback. You had buyback the shares. See, so I have already linked everything. So this will be 0. This will be 6 million, and dividends was already linked. So again, I link this dividend. If there are anything which was added now, you can always add a row and do it. Let us say I have taken a debt. The debt was not there. So you can add and you can do it. Here, what is my cash flow from financing is this much. So I have purchased my shares. Buyback is a cash outflow, right? Buyback means you have purchased your own shares. When you purchase your own share, you pay cash to the equity holders. And then this is my total cash earned. So I have not earned. And my closing balance will become opening, right, next year. And then total my closing balance will be 183. And I do this 183. What is this difference? Sorry, the cash flow from operation. Sorry, will be what is the cash flow from operation is this much. Okay, sorry, I have linked it. You see, your manager is telling automatically that difference was 1672. It came over here. I know this was the difference, right? Previously 1672. That should be exact cash balance, and that should not. You should not write it. It should come. So in BCom or in 12th standard, we had taken cash as an balancing figure. But ideally, when we go to finance, cash is not a balancing figure. It should come from the cash flows. Okay, cash is not a balancing figure. It should come from cash flows. And it tallies. See, you will see the exact difference. The closing balance was 1692. How? This is the cash you have earned, and this is what was from last year. So total cash in your bank account is 1672. That reflects in your balance sheet tallies. Now you can just drag it for how many years, whatever years you want. You can drag it for how many years, whatever years you want. Okay. Got this? How to forecast now? Forecasting is quite easy. Once you know now, once you have solved this, you have to just copy paste many of the things. Again, you do any changes. Here why modeling is important. Let us assume that I need a capex of, let us say, 10 million. Example, I'm assuming that I will need a capex of at least 10 million next year. Okay, fine. This is what I assume. See what happens to my cash. It becomes negative. No. Now, when it becomes negative, can you do? This is forecasting. This is for next year. You are making your, forecasting was making a budget. Okay. Your parents do make a budget. We make a budget for next month. Our day-to-day expenses. What is their expenses and all. So if I think that I want to buy something and I don't have money, can I buy? Can I buy? And balance sheet items can never, those are balance sheet is telling, but the balance sheet items can never be negative. Now this modeling helps you know all those things. Whatever you are making a budget, is that sensible? The budget that you are making, that you need to buy this much or maybe spend this much, is that sensible? Now what to do? If I don't have money, what can we do now? Now we need to borrow money. Yeah, or fresh capital, that is. So now once you are capital, usually if you are a mid-sized company or maybe 5-10 years into the business, it's better to take a debt than again raising equity, because equity will reduce your existing ownership. So ideally it is recommended to take a debt. So now let's take, since we have not taken debt, let's assume that we'll need a debt. Okay. Now I assume that 10 million. I assume a debt of again 10 million. Okay. This assumption again I'm assuming. Okay. Opening, I've made a debt scale opening. Now borrowing, I assume that I need a debt of 10 million. Okay.
I assume that I need a debt of 10 million. I have not repaid. Okay. And let us say opening plus borrowing minus closing. 10 million. Now this becomes opening. I've not taken anything as of now for next year. Okay. This I'm keeping it. Okay. 0 as it is. Okay. Now this 10 million, where does it reflect 10 million? This is for FY23, 22. The balance sheet liability side, it should reflect now you have taken a debt. That was a long-term borrowing. Okay. That is called borrowings. Long-term borrowings. Now I will take this 10 million. So which 10 million? This or this? Which should I take on the balance sheet? Always the closing figures. Always the closing figures. So 10 million. When I do this, see what happens? My balance sheet is not tallying. Why? Add in the cash, right? You need to add which activity it is. It is a financing activity. Now here, what you can do, since it was not there, I will add it. I will add rows and do what is debt issue. Additional, you can say additional borrowing or borrowing. Okay, this is borrowing. Borrowings, and just make sure when you borrow, also you have to repay it. You just write borrowings and repayment. Okay. So borrowings was inflow outflow. Yeah, inflow, right? This now which 10 million? This 10 million. Okay, it's an inflow. So addition and then repayment is an outflow. So is equal to minus sign. Okay, outflow. Though it is 0, but make sure you link it because it will help you in the future years. And make sure you again add it over here. So it is not added. In total financing activity. Then see, balance sheet will tally. Next year this is okay, it will tally. What will come in debt? Yeah, this will come in debt schedule. Yeah, this is debt now. I have created a debt schedule. Will come in debt schedule. Okay. See now your cash balance have increased. Is it? Oh, we have increased. Okay. But now debt comes with an interest. Am I right? We have not taken interest as of now. We'll take it today. Debt comes with an interest. Am I right? But we'll hold on to it as of now because I have to tell you one more thing. That will help. We'll hold on to the interest part. As of now, just this, okay? And we just tell you about this now. Inventories and all. See now, guys, you know what is receivables? Receivables and payables are two things which are there on your balance sheet, which are all current assets. These are all long-term assets. These are all short-term assets. Money which we need to receive. Yeah, data. Those who don't know, receivable is the amount where money is not received, and from where you have done a sales of 5 million. Okay. Now I have said that from this 5 million, see, it is not possible that all the money that you must have got. Usually cash sale doesn't happen. It's always credit sales only. So I am saying from this 5 million, I'm saying that 2 million I have not received. Okay. So now it is my asset. Why asset? Rather than saying asset, I will say it is an application. Now why application? See, is it a source? Is it a source? What I said, application, this is application, this is source. Keep it simple. Why is an asset? Because see, application means you have applied it somewhere. Source means you have got. So is this the money that you have got? I have said this is the money that I have not got. Is it a source? It is not a source, right? It is not a source of funds. It is what you have not got.
Source for future. So it is application, right? Whatever it's for future is assets. Whatever you will get it in the future, it is asset. Okay. Whatever you get now, it is your liability. Okay. Now same way, if I say this, okay, receivables were 2 million. Out of this, now payables is what, from the one you the suppliers, the money that you pay to your suppliers, that are called creditors as well. The one that when you buy, when you sell products, obviously you must have buy goods in a grocery shop. Obviously you must have purchased from the wholesaler. He's your supplier, right? So you have to pay your suppliers. Now this was the cost that you were supposed to pay your supplier. But I am saying out of this 2 million, you have not paid. You have not paid 50,000. It's a 500,000. You have not paid 500,000. See, listen carefully. I'm saying you have not paid 500. So is it your source or application? Is that money still with you? Is that money still with you? You have to pay, right? You have not paid it yet. It is payable. You have to pay it. So can I say it's a source? As of now, you have, right? You can do whatever you want. So it is said to be your source of funds, payables. Okay. Now, how does this affect? Now, I will take this again. But what happens practically, you don't get. So I'm just assuming these all numbers. Now here we don't create inventory schedule. The inventory schedule is to be scrapped. Inventory schedule is to be scrapped. Okay. There's no inventory schedule. This was just for your understanding. Okay. Now tell me, what was this inventory? See, you had. So here, what I'm saying that, see, I had, in that accounting, when we first class, I told that you should take only the cost which is related to the sales. But you had purchased more inventories. You had purchased more inventories. Now that is why this has been reflected on your balance sheet. That 200, so you have taken as a cost, but you have also purchased 1 million more. That is not reflected anywhere. But is it your cost? Guys, is it your cost? Did your cash go out? Or did we receive the cash? You had sold 2 million of inventories, but you had actually purchased 3 million of inventories. This we come to know by taking this inventory item. So it was an outflow. So in the cash flow statement, what should be my entry for inventories? Is it a cash inflow or a cash outflow? 1 million additional cash, okay? Because all the cash you have taken and all the cash is all the profit is reflected over here. It's an outflow. So what we do is you usually take a negative sign. So that is an outflow. And then the balance sheet tallies. Okay, now next year, now let us say this 1 million of inventories become 1.5 million. Okay. 1 million of inventories became 1.5 million. Now what is this? Your inventory increase? In your shop, your inventory is now increased. So what is the impact on the cash flow? Is it a cash inflow or a cash outflow? Your inventories increase. No. See, it is an outflow now, because whenever you buy inventories, you require money to buy the inventories, right? No one will give you on credit. So inventories, you require money. So it is a cash outflow. So outflow, how much? Should it be 1 million, 1.5 million? How much is the outflow now? It should be 0.5 million or 500,000, whatever. 0.5 million, because why? because now your inventory has increased, but it has increased with a number. Okay. So now in the cash flow statement, you said it should be an outflow. So now to get it directly, see, I don't have to punch anything over here. I'm again telling you don't have to punch anything. Now I have to find an outflow, right? You know that it's an outflow. So outflow means I need a negative sign over here. So what should I do? 1.5 minus 1 or 1 minus 1.5? I need an outflow, so I need a negative sign from the calculation. Correct? 1 million minus 1.5 million. You see now when this gets added, my balance sheet tallies automatically. Means what? See, what is that? If everything is constant, my inventory is increased from 1 million to 1.5. So obviously I would have purchased it by my asset only. I mean, I would have purchased it from my cash only. So this increases and my cash decreases. So this only happens here over here. What happens? This is 3.8. This is so 1.1 became 1.5. So something should decrease, right? So what decreases is your this minus this. Okay, now what if it increased? What if it increased? What if it increased? I'm sorry, what if it decreased? Decrease, sorry, not increase. What if it decreased? It becomes, let's say, 500,000. So cash inflow, outflow. Now means this means that you have sold your inventories, right? So there's a cash inflow. So I will have a positive figure. So if I enter this, see, I automatically get a positive figure because I have done it this way. So what is this? This is your previous year minus your current year. Okay. So this is also what your previous year, it was 0. So it was 0 minus, that is why it comes like this. Okay. It was 0 minus this because there was no previous year. It was first year only. Okay. So always previous year minus current year. The same way for receivables. Okay. Same way for receivables. So now I have not added over here. Now my receivables made 2 million. 2 million became 3 million. You know, forget about the amount. Forget about what does receivable means. You know that it's a source. It's an application. Sorry. Consider this as an inventory again. Consider this as an inventory. You had an asset of 2 million. Now you have an asset of 3 million. So when your asset increases, what happens to your cash? Does your cash increase or does your cash decrease? When your asset increases, means what? You have purchased more inventories. When you purchase more inventories, what happens? Your cash decreases. So can I say I can use the same thing again? Previous year minus the current year. So my cash reduces and then my balance sheet tallies. In the same way for this year, previous year minus current year. For same way for this also, previous year minus current year, but we don't have previous year, so we take 0. See my balance sheet is tallying over here. See, balance sheet is tallying. So I will let you know how to get these numbers, but as of now, I'm just using it. How to focus this number. Okay, see everything we have forecasted. We have forecasted this. We have forecasted this. We have forecasted this. This. All we have forecasted. Now this should also come from a forecasting that we'll learn. But first, just know that how this changes happen. Now one more thing was remembered. That is your payables. You know, let us say your payables became from 500, it became 600,000. From 500, it became 600,000. You know, payables, consider it as your debt. All liability source, right? Source of fund. If your source of funds increased, so what? Inflow, outflow. Means now you had a loan of 500,000. Next year you had a loan of 600,000. So you have taken 100,000 more of loan. So inflow. If I want an inflow, so how will it impact my payable? How will it impact my cash flow? There was a 600. So 500 became 600. So I want, it's an inflow. So I want a positive amount. So what should I do? Current, yeah, right. Current year minus the previous year. Right, this 1 million and make sure you add it in your cash flow statement. Okay. Same way it will be now for liabilities, it will be current year minus the previous year. So minus the previous year. So this will be all asset will be previous minus current. And since we can do it over here, but since last year was 0, so what we take is we take 0. Okay, and it tallies. I do it tallies. See, it tallies. So this is your part of your. This is the figures that are not reflected on your P&L. Rest all the items are reflected. Am I right? PAT, only 2 items are there. PAT and depreciation are reflected. Means all the costs are included in this. Now see what happened. Now when I did this, see my cash flow from operations became negative. You see? Here I see I have 14 million of cash. Did I earn anything on the cash flow? Did I earn anything from the operations? See, I had done a profit of 1.5 million. Profit is positive. This is the cash that I've earned. But I have also spent on this because when I say that, this amount, 1.5 million that I've earned, 1.5 plus 5 million, this 2.4 that 2.04 that I've earned, but I didn't understand that out of this 5 million, I have not received, out of this 5 million, I never received only 2 million. You see? I say this. First, I assume what this is the cash that I've earned. But and how did I came at this? That this is the cash earned and this is all the expenses paid. But then I see that from this 5 million, I have not received 2 million. That's a difficult thing to understand. Means that though I have done a profit of 1.5 million, that is a virtual profit. I have not received my cash. And plus, even I need to invest in inventories. That is also not reflected over here. This is my cost, but how much more I have invested, that is also not seen. So those all things are reflected on your cash flows, and your cash flows actually become negative. And this company, can I say this company is working on funding? How much you have fund? Total of 19.8 million you have fund, and you are just burning cash over here. Is it a good business now? Is it a good business? Your profit is positive, everything is positive, EBITDA margin also positive, but you have not earning only cash. Now, is it a good business to invest? It's not a good business. Your cash is all on funding. Just funding your, all the money, all the companies running just on funding. Once your, debt stops, you will not be able to, fund more amount. So always remember this cash flow. That is why this cash flow statement is most important. And this working capital changes one of the important things used in valuation, that you need to invest this much of things. Okay, this was actually to be this. Your actually the next year we have done positive because we have earned much profit over here. But what if my sales don't increase by 30%? Let us say my sales only increase by 5%. Say my cash is positive, so it's okay. No, but now there's a risk. If my sales decline by 5-6%, I might suffer a loss. Oh, my cash flow is now very less. Yeah. Now how do I assume this is, we also make a schedule for all these payables, receivables and inventories. Okay. Now let's make this is called our working capital schedule. This is called our working capital schedule. Now, what is this working capital schedule? Now, how to find? Now, commerce guys must be knowing the ratios. Now, let's go on ratios. Now, how to find? What does that receivable means, and how does that changes? Okay, in our example, we had taken our inventory, our sales at 5 million, right? We had taken our sales at 5 million. Let's take 500,000. Okay, as of now, what was it? 5 million. Now, what was our sales? 5 million. Mute, I think someone is. It was 5 million. Okay. Three zeros. 5 million. And I said my receivable was 2 million. Right? Now, what does it mean? This was my sales. This was my receivables. Now, what does it mean? That see, I have to always compare it now. Always compare it with my sales. Receivables will go with sales. So there's something called receivable turnover. Receivable. Now, what is that receivable turnover? Is that if 5 million was your sales and 2 million was your receivables. So how much times is your sales of receivables? Because you get only this number. How much times is your sales? Into this, what is it? 5 divided by 2. 2.5. So at given point in time, this means that I received the money 2.5 times in a year. What does it mean that I received money 2.5 times in a year? Receivable turnover means this only. 5 by 2 means what? See, sales by receivables. Now this turnover, now what is this resemblance of turnover? So turnover is not used practically. There's something called days of receivables is used. Means what? If I receive money 2.5 times in a year, and in a year there are 365 days. So if I do 365 divided by 2.5, it comes to how much? I do 365 divided by 2.5. Comes to 146 days. Means what? This is days. Means what? I received the money in 146 days. Good sign? Good sign? When you are selling something and you are receiving the product in 146, 146 is how much? 4 months, 5 months, almost 5 months, right? So this is not a good sign on the receivables part. Okay, means there will be a problem with your receivables. Okay, always the less is better. Now, how did we find this? There's a formula to it. Now I will not say there is a formula. It is always times. Whenever you get a receivable number, you get. Okay. So how much times you sold is 2.5 times you sell. Means the sales are always 2.5 times of your receivable. So when I say 3 million was received, I can say 3 million was received, but you don't get the 3 million number. What you get? You only get the receivable number. So I say my receivable was 2 million and my sales was 5 million. So I know that my receivable is 2.5 times. And from the 2.5 times, I can know that I get my money in 146 days. So obviously not a good sign. The same way it goes with receivables, same way it goes with your inventories as well. Same way it goes with your inventories as well. Now what is it? Inventories goes with cost of goods sold. Now what is it? Inventory. Now let us find inventory turnover. Okay.
inventory turnover. Now, what does it mean? Inventory turnover means how many times you sell your inventories in a year. How many times you sell your inventory. See, when I tell sales, so it should not be sales, because sales, you earn a profit on sales. Inventory is like, let us say in your shop there are what was our example, 1 million, right? In our shop there was 1 million of inventories. Okay. In our shop there was 1 million of inventories that you keep every now and then. And now how much you sell? So sell shouldn't be your sales. It should be your cost of goods sold, not sales. Because this is the cost. Now we are not finding profit over here. Okay, we are just finding that if you keep 1 million inventories in a year, so you sell 2 million. See, at a given point in time, can I say that 1 million inventories are there, so you sell 1 million and you buy 1 million, right? Again, when you go to a grocery shop, do you find a grocery shop empty? And whenever a grocery shop sells something, he buys, right? Again. So likewise, how much times he does? He does 2 times in a year, because I know that he has 1 million of inventories and he sells 2 million in a year. So obviously when he sells his 1 million, he must have purchased more 1 million. So this is your COGS, cost of goods sold, divided by inventories. Okay, just get this right. Cost of goods sold divided by inventory. So if 2 times in a year, so how many days? Days of inventory. How many days? Will be 365 divided by 2. That is almost 183. It comes 183 days. Comes 183 days is what is required to sell your inventories. Good thing. Yeah, does it make sense to hold 1 million of inventories? It means you are spending so much of amount in this working capital. Means you are investing so much of amount in inventories. Then I can write this formula somewhere. Okay. The same way goes with payables. Days of payables. Sorry, payables turnover. Payables turnover. The same thing. Payable goes with what? From one who purchases. So it will be purchases divided by your payables. So in our examples of how much was your paid for your payables? Payables were 500,000. The payables were 500,000. Achha, now what happens? Purchases amount you don't get on live balance sheet. There's an issue that you don't get the purchase amount and you cannot find also. So instead of purchases, you can take cost of goods sold. Okay. Instead of purchase, you can take cost of goods sold. Means what? Means what you assume that if you have sold this much of items, so obviously you must have purchased that. Am I right? If you don't have the purchase amount, this can be given a good thought that obviously if you have sold this much, so obviously you must have purchased that much. But now what happens? Usually you purchase more than the cost only. It is not, how much you purchased, all what you sold. It is not always that how much you purchase, all that you sell. So what happens? So in the whole P&L, the only amount which is more than the cost of goods sold is your sales. So ideally, if you have a purchase amount in your interviews, everywhere you get a purchase amount, then you have to write it. But in case you don't have, you can either take COGS or either take sales. So sales, I say, because the cost of goods can be a precise amount that obviously you must have purchased this much. So you must have sold. So obviously you must have purchased. But you usually purchase more than what you have sold. Usually, not always, but usually you purchase more than what you have sold. So sales is the only amount that is more preferable, okay, to take. So in an example, our sales was 5 million and our payables were 0.5 million. So how much is it? Is it almost 10 times? So 10 times a year, so in days of payables will be 365 divided by time. That is 36.5 days. So inventory not sold at once. Yeah, we are not talking about inventory, no? Cost now, we are talking about cost now. Cost we sold at once, no? These are all year-end numbers. All year-end numbers. Inventories and all year-end numbers. Okay. What is there at the end? It's not today's number or no, what you have purchased today or what you have sold today. It is over the year that you have sold. So it means that you have holding 1 million of inventories and you have sold 2 million of it. So you know that this shop sell 2 times of inventories in a year. Okay. Now this is, we got it for year 1. Now let us do it in our example. Okay, in our this. Okay. For working capital schedule, what all things we require? Okay, I will just put it over. You know, we require sales, we require COGS, right? We require sales, we require COGS, and we require purchases, but purchases is not there. So what we do is we take sales from sales only. Okay, purchases are sales. If the amount is there, we take it. Now sales, we get it from our P&L, right? It was there, sales were there, and our cost of goods was also there. Okay. Now what are things is required? Receivables, inventory, and payables. You know, this amount, though I have forecasted, but now since the first year amount you will get. Okay, for forecasting, first year amount you will get. So whenever you take a live company, first year amount will be given to you. So as of I have given to you. Okay, this I have given, inventories I have given. Okay, and payables also I have given. Now you have to forecast it for next year. Okay, this is all given. This all will be given to you. Now you have forecast it for this year. You know, sales you have forecasted. You have already forecasted. Sales you have already forecasted for next year. Sales and cost of goods sold. Am I right? This is what you have forecasted. Now, how will you forecast this? How will you forecast this one? Now, we have to forecast it using our ratios. That is our days of receivables, days of inventory, and days of payables. First, we'll find it for a current year. Acha, see this formula. I will write one formula. Okay, days of inventory. Okay, I will write this. Now, what was the formula? It was 365 divided by inventory turnover, right? And this 365 divided by this was 2 was what? Inventory turnover, right? Now, how was this arrived? Can I say 365? If I split up 365 divided by inventory turnover, what? COGS divided by inventory. Can you solve this equation? Can you solve? Can I do 365 divided by COGS divided by directly? Can I do this? 365 divided by this and then again the whole divided by this. Can I do that? You know, guys, this is maths. You cannot divide 3 things at the same time. What happens? The last one over here becomes multiplication. So what is it? At 365 into inventories divided by COGS gets you directly days of inventory. See, now this is the formula to be remembered because when you go for interviews, you know, solving this way is okay. I'm not saying it is wrong. Solving this way, first you find a turnover and then you find the days. But here what happens, the numbers will not be so easy. If you give a annual report, it will come something in 2.45 something. So every time you have to do 2 times calculation on your calci. If calci is given you have to do it 2 times. The interviewer watching you will understand that, no, if he asks you that, find days of inventories from a balance sheet. So if you do this way, cost of inventories divided by cost of goods divided by inventories, and then find an answer, and then again 365 divided by that answer. It shows that you only know formula, you have not understood the formula. Rather than saying that, this is the direct way of doing it. 365 into inventories divided by cost of goods sold. And how do I remember this? Is that, see, whatever is asked, what is asked? Days of inventory is asked. Days means 365. And what is asked is inventory. That's it. Divide by COGS goes with inventory. Right? Same way if I ask for days of receivables. Same. Days of receivable means 365 is what is the days. And then what is asked? Receivable is asked. So just 365 to multiply and then divide with what? Receivable goes with what? Whom we compare receivables with? Whom we compare receivables with? We compare receivables with sales. This is how I remember it. If someone asks me to find days of payables, so I know that days means 365. Then into what is asked? Payables is asked. The formula is here only. Payables is asked, and then divide by, now payable goes with what? Payable goes with what? Purchases, right? If you don't have purchases, ideally it should be purchases. If you don't have that figure, you can take sales. Right? Very important formula. Just keep this in your mind. It will help you in your interviews. This is smart answering rather than, answering with just formulas. I hope what you mean that. Huh? Okay, now can you find over here an example? What was days of receivable? Days asked means 365. It goes with what? It goes with receivable. What is asked? Receivable is asked. And then divide by days. That's it. 146 days. Same way for inventories. What is it? What is our days? Is asked. So days into inventories. This is what you know. Divide by cost of goods sold. Since I have now done it smartly, one below the other, I can just copy this, copy and paste this directly. If I put the formulas right for one thing, I can just copy and paste, and again I can just copy and paste. Yeah, get this. You see, I get this amount. Fine, got it? Now there's something called cash conversion cycle. Now, what is this cash conversion cycle? Or it is also called working capital cycle. Working capital cash conversion or working capital cycle. Now, what does it mean? There's no formula to it. Let us talk about some easy numbers. See, days of inventory. I say that it took, let's say 60 days for you to sell your inventory. Okay. Then it took more 30 days to receive your money. Okay. So really, after how many days you received your money? After selling your inventories, after how many days you received your money?
right? 90 days, 90 days. But now I say that the supplier has given you a credit of, let's say, 20 days. Okay. He has given you a credit of 20 days. So ideally, can I say you received money back in 70 days? Can I say this? Can I say this? That ideally you receive the money in 70 days. See, how is it? How does it goes? Let us say today is, let's say today is 1st November. Okay. You go and purchase, you go and purchase materials from your supplier. Now he gives you a credit of how many days? 20 days, right? So do you have to pay now? Do you have to pay today? You have to pay on 20th November, right? You have to pay the money on 20th November. And so we'll start from over here, right? We have to pay on 20th November. So today you purchased, let us assume today you also sold, okay? You purchased the goods from supplier and you sold it. After how many days you sold? 60, right? It took 60 days to sell your inventories. From 1st November, not from 20th November. From 1st November. So 60th day will come when? Just assume 30 days a month. November, December. That's around 30th. Yeah, 1st Jan. 1st Jan you will receive your money, right? So you sold your inventories. Till 1st Jan you sold all your inventories, right? And then when did you get your money back? After 1 month, that is on 1st Feb, you received your money back, right? Right, huh? Whatever you have invested, you received on 1st Feb. So from 20th November to 1st Feb, how many days was it? You sold on 20th November, means you have given the cash on 20th November. So how many days of credit you got? 70, right now? 60 and 30, receive the money in 90 days, but you have to pay it what? From here only, you have to pay over here. Can I say minus 20? There's no formula to it. This is practical things it work. So you have to pay it on 20th November. You don't have to pay, but you have sold it in 60 days. This. But you don't have to pay on that day. You have to pay after 20 days. So 20 days credit you have got, and you received your money after 90 days, and 20 days credit you got. So ideally you received your money in 70 days. So in our example over here, it took 183 days to sell your inventories. After 146 days, you received your money, and then you paid in 37 days. So now, means to get back your money, it is taking you 292 days. What is cash conversion cycle? Days it took to receive your money back. Days it took to receive your money back, which was invested in inventories, right? To buy inventories, you have invested money. Over here, you have invested money to buy your inventories, and then you sell. It takes 60 days to sell, and then you receive your money. So total, ideally, it takes 242 days. This is very vague. Let's change the numbers. If 290 days, then there's no point doing business. You're receiving your money after 1 year. Let's change numbers. Okay, let's keep some easy numbers. Okay. 6, and let us do this.
Okay, fine. Nowadays, okay. Now this is still okay. Okay. See, now it has changed my CFO. Okay, it must have changed my CFO. See, now my cash flow is positive. Okay, because that was very, that why it was negative, because it was a dangerous thing to receive your money after so many days, 292 days. Now obviously don't do the business. Now this is what I have assumed. Next year, there will be some numbers. Okay, over here it is like 21.9. So don't assume that next year you will receive money after 21.9. There's nothing called what is 21.9 days. These are all days. Means 21 days and 9 hours. Okay, it doesn't work like this. Okay. So whenever I say 21.9, so assume it is 22 days only. Okay. You receive your money approximately 22 days. If it is 109, so assume you receive in 110 days. And then if it is 36, so assume that 36.5, so assume that it is received in 37 days. Don't say that I received money in 36.5 days. Okay. It's a very bad representation. Now what I do is I keep this constant. Now from this constant, I have to find my receivables. Can I find receivables? In this formula, now I have my receivables. I have my days of receivables. I don't have this. Can I find? Days of receivables was what? It was 365 into receivables divided by, come find. What is the answer? Tell me. Receivable days are 22 and sales are 6.5. Just take 6.5 million. Don't take a big six, just take 6.5 receivables and then we divide by what? Sales. And we already have this. We have to find receivables. So receivables, to find, what we do is cross multiplication. Days of receivables into sales divided by 365. That's the answer. Days of sales were 22, receivables. Sales were 6.5 divided by 365. What's the answer? What's the answer? 39 point. Okay. Now what you will do for, if I ask you for inventories? Find inventories. How will I find? You tell me, how will I find inventories? To find my inventories. I have to find inventories. What should I write? I'm waiting on days of inventories into what will be COGS divided by 365. Same way goes with your payables. Now this is how you find it for next year. There is 22 into sales divided by 365. Now since I've done it once, I can just copy paste it down. I don't have to do it every time. You see, I can just copy paste it down. Now this is my closing balance. This is what I have come up with, a closing balance. Okay, these are directly I found here. In this schedule, there's no opening and closing. Okay, opening, addition, and subtraction. Okay, you don't buy or sell receivable. It is all depending on your sales. Can I say this is all depend on your sales? Can I say this? This is dependent on sales. Now this is dependent on cost of goods sold, but cost of goods sold is also dependent on sales. You see, cost of goods is coming from where? Sales, right? Everything is coming from sales. So one change in sales, impacts so many things, and that sales directly impacts your valuation. Now over here, what I will do, I will just link it from the things that I found. Payables was over here. I found this link. Now payables is new. I have found. Okay, payables new. Next year payables. So payables have increased. Cash inflow, outflow.
Payables have increased. Cash inflow, outflow. Inflow. Now on receivables. Receivables is what? It has also increased. Receivables have increased. Inflow, outflow. The asset increase. So inflow, outflow. Outflow, right? So see, since you have already linked that numbers, over here, it automatically gets tallied. You see, all the changes happen automatically because you have already linked that inflow, and there's outflow, and then you get your answer. My balance sheet tallies. One change in sales, see, everything will change. Your working capital will change a lot. I do a change. 30%. Only assumption, I just change one number. Okay, I just change. Whether I do to 80. See your balance sheet, what all things changes. I just do it 80. If I press enter, see, so what all things will change? Can you tell me what all things will change? Guys, one by one. What changes on the liability side? What will change on the liability side? Payable and what will change? Only payables will change on the liability side if my sales increase. Reserve will also change because my other equity, my profit will change. If I change my sales, my profit will change. Okay, there's two. Anything else that changes on the liability side? Anything else? No. Right. Now what change on the asset side? What will change on the asset side? Cash. Then the cash. Yeah, cash, inventory, receivable. Except PP, everything changes. Because cash and cash will change from over here. See, everything changed, but my balance sheet still tallied. See, and my cash flow from operation increased because this impacted my cash flow from operations. Got it? Got it? Modeling. Now this is all your modeling. That is where if you make 3 schedules, equity, other equity, PPE, working capital. These are the important schedules. Then debt is an optional one. Debt is an optional. Usually for interviews, they don't ask you debt schedule. For interviews, they ask you this only. Asset, how does asset change? How does depreciation changes? Depreciation, one of the important thing. How does depreciation changes? Then your working capital changes. Now working capital changes, if you know the formula, is pretty straightforward. Now, this you need to know. Now, if I give you any other entry, adjustments, let us say I purchase an investment of worth 500,000. How will this impact my balance sheet, P&L and cash flows? Tell me. If I made an investment of 500,000. So obviously investment means I have applied. So my balance sheet will change, right? Then what happens? Cash decrease. So which activity? Which activity? Investing, right? Investing activity. Go over here and say purchase of investment. Okay? Purchase of investments. Okay. So now this should be your negative sign. Okay. Now here you can also create a schedule, but now you can do it directly from the balance sheet because it is, there's no opening and closing over here. Investment 5,000. Obviously, then my cash will reduce to 5,000. Okay. And let's say next year I sold my investment. Now the value of my investment is 4 lakh. Then next year my value of my investment is 4 lakh. Then inflow. Yeah. How much is the inflow? How much is the inflow? Yeah. So for inflow, what we do for asset is previous year minus current year. You can do it for all assets except your PP and your other equity because dividends are included. Rest all you can do it directly on your balance sheet. This is you need to know that what changes happen and where it impacts. Okay. What changes happen and where does the thing impact? Fine. All right. Everything clear? Everyone clear till here? Any doubts? You can do. If I give you, okay, if I give you, let us say, if I give you deferred tax liabilities. Deferred tax liabilities. I say that deferred tax liabilities, okay, increased by 3,000. What does that mean? Deferred tax liabilities increased by 3,000. Cash inflow, outflow. Since it's an liability, so it should be an inflow. So increased by 3,000 means obviously there will be some amount and then it increased by 3,000. So there's a cash inflow. Okay, prepaid expenses. You know what is prepaid expenses? Prepaid expenses increased by 3,000. Now first you have to assume that whether that prepaid expenses, it's a liability or an asset. Prepaid expenses, means what? Those who don't know, prepaid expenses means, subscription. When you give, it's an asset, it is not an expense. It is said to be an expense. It is written as prepaid expenses, but it is not an expense. Okay, it is an asset. You know how subscription for Netflix or subscription for your Amazon Prime. You pay first and then you receive the services. It is not that first you receive the services and then you pay. This is like, so what is that you have paid in advance. Okay. These prepaid expenses are also said to be advance payment. Okay, for you, if you have done anything advance payment, see, till you don't receive the services, you cannot say that it was an expense. Okay. Till you don't receive the services, you cannot take, because what accounting says that you should only take expenses for which you have received the services. Okay. You cannot take expenses that you have received services. So this is advance payment. So now advance payment is not an expense. Now, is it a source? Now, how you find whether a source or application, asset or a liability? And don't get confused if you guys get confused in asset and liabilities. What is it? Only there are two things, source and application. Was advance payment a source for you? You have paid, right? What is a source for you? Did you receive cash? No, right? If you don't receive the cash, then it's an application only. There are only two things only on the balance sheet. Source and application. Just you have to only know about source. Application also, if you think that it is difficult, think of source, whether it's a source. Okay. Now let's say earn revenue. Earn revenue means now this advance you have paid. Now let's say you have paid this advance to me, right? Example, you paid to someone. This is for the ones you paid. Now let us say you have received money. You have received an advance money. So when you receive the money, can you take it into sales? Yeah, see, it is, we have received the money, but we have not earned it. Am I right? Now, when you go to classes, let's say you are starting a classes. Let's say you are taking a classes from me. You pay me in advance. So can I say it is my sales? See, I have earned that. I have received the revenue, but I have not earned it. When will I earn that? When I give you the service, that time I will say that I have earned that revenue actually. That is not your revenue again. Okay. So if it's not your revenue, then obviously cash has received, right? So cash is received. So it's source or application? Cash is received. It's a source or application. Unearned revenue is advance received. Right? Source, you have received the cash, right? So it's a source. These are few things that are, prepaid expense and unearned revenue. You should know what does it mean. Prepaid expense, advance payment, and this is advance received. Only the words now in finance and accounts, they use some difficult word. Those who are not from the finance background, accounts background, is okay. It is all day-to-day business only. The one who do business, they know all this stuff. You don't have to advance receive. For them, you know that it is not an expense. It is not an income, sorry, because you have to give services to them. If you are not able to give them the services, you have to, pay them back. Am I right? If you enroll for any classes and these classes guys don't give you services, you are entire eligible to get that money back. So they cannot say that it was my income. They have to keep it on a liability till they don't give you the services. Okay. Fine. Fine. Done. All good. Will you able to do a model like this? Now I have created a model for a company. Now see this I have created. I have given you all the assumptions. Now this is live numbers, okay? Now these assumptions are again random, but I have given you the assumptions. All this. Okay, now you have to only talk about cost over here, okay? This cost is over here. You don't have to take all this cost. You have to take all the numbers which are bold. I've given you assumption the total cost will be, yeah, Mahesh?
Hello, sir. Am I audible?
Yeah, you are.
Actually, you made a working capital schedule. Okay. In the books, we have read that working capital equal to asset minus liabilities. Okay.
Hmm.
So over here, you have written like days of inventory. This is called ratio analysis, I think.
No. See, this is asset minus liabilities only. But see, since you are making cash flows, it is change of asset minus change of liabilities. You see, this is change that you are taking, right? What you are doing? You are doing asset minus liabilities only, right? Over here. Here your asset is high and liability is low. Sorry. You see, your assets are low and liability is high. That is change, that how much amount you have invested in your asset and how much you have paid. Working capital means what? Don't go with that formula that current asset minus current liabilities. Working capital over here means that how much money that you require to run your day-to-day business apart from your normal expenses. Okay. Apart from your normal expenses. These are normal expenses, right? All the normal expenses were created in PAT. But these are the expenses which are not reflected on the PAT and in your P&L account. That is why you take it. This is called your change in working capital. If you club this, it's called change in working capital. See, here go with the literal meaning of working capital means capital that is required for your day-to-day operations. Means that over here you required 400,000 extra amount to invest because 400 extra amount up and above your profits, then only you can survive, because this is actually needed for you. Without this you cannot do your business. So this is change in working capital. Okay, not working capital, change in working capital. How you find it? From this formulas you find it from the working capital schedule. Okay, fine, got it. So guys, I have created a balance sheet. Okay, These are live numbers. This is a live number. This is a, I think it is Hero MotoCorp. Yeah, this is Hero MotoCorp model where I have estimated a sales. Okay, this is all you see. This all coming from this number. So you just have to all the bold items you have to copy paste. But here remember that this bold is not copy pasted because this should come from a. So I will just do it on. This should be sales into cost of goods sold. Okay, this should come like this and then drag it. Don't drag it, just do it for FY22. See whether you are able to tally the balance sheet or not. These are the historical numbers. This you have to forecast. If you are able to do it for full year, better. If you are not, it's okay. 1 year is important. Then second year is just dragging. The first year, you have given all. Now this is year on year growth. This is percentage of sales. Same thing that we did today. Then balance sheet. Okay. Then go to cash flows. See, in the cash flows, there are all other items you don't need to change. You only need to change what is marked in yellow. Okay. What is marked in yellow. Achha, okay. Finance cost is remaining. No? Sorry. 1 second. Finance cost now over here. Okay. Our interest was remaining, right? In this example, our interest was remaining. No, we had a debt, but now debt comes with an interest, right? Debt comes with an interest cost. So I say that the interest rate is 10%. Assumption, okay, again assumption. I will let you know how to take this assumption when we take on live companies. Okay, these are all assumptions. As of now, it's my all assumption. What will be interest expense? What will be interest expense? If my interest is, my total loan is 10 million, so can I say my interest expense will be 10% of this? 10% of the closing, not the opening, not the addition of borrowing, 10% of the closing of, because this is the total loan that you have, and this is the total expense that you. Okay. Now, in this, now what is this? Where will this reflect? Where does this interest expense reflect? In the 3 statement, in the P&L, right? Transfer to. Okay. We'll transfer this to P&L. Here, the interest expense, I will transfer this to the P&L. That is your, there, this one, your interest expense is 1 million. Okay. See, when I do this 1 million, my balance sheet still tallies. You see, there's no impact. Because what is happening, other equity is reducing. At the same time, my cash is also reducing with the same amount. Right? How will cash reduce? From over here. Right? Because PAT is directly linked. My PAT reduced, so my cash reduced and my other reserve reduced. So there is no impact on my balance sheet. It's directly I just take a number. But what happened actually? My interest expense is which activity? Interest expense is which activity? Financing, right? Then financing activity. But my PAT is operating activity. I have assumed, right? PAT is my operating activity. So because of my interest expense, my PAT, my cash flow from operation reduce. Is that the right way to say now? Because I added interest, my cash flow from operation reduce. Should that happen? Should that happen? Right? Should this happen? See, it is a cash outflow. I'm not saying it is not a cash outflow. It is not like depreciation that you need to add it back because it's a cash, non-cash item. It is a cash item, but that cash item is reducing your CFO. So what we need to do? So we need to make adjustment to our PAT or CFO rather. What is it that we need to add back interest over here, and we need to subtract it from the cash flow activity, financing activity. Because it is a cash outflow. See, if you just add it over here back, what was it? It was 5 million, 500,000. Sorry, 1 million. It was 1 million. If you add it over here back, no? If you add back, see, there's a difference. Right? There's a difference over here. We make sure you subtract it back again. And subtract is that just you have to link it with the above amount, right? This one. And this will tally your balance sheet. Okay. Now this is one of the changes that you do to your balance sheet, to your cash flow statement. This is what you need to do because of the interest being added, your cash flow from operations reduced. Okay. These are the changes that you need to do your PAT. What are the changes? There are three changes. One is depreciation, one is interest, because those are non-operating. One is non-cash. This is non-cash, right? This is non-cash. So obviously you need to add it back. And this is non-operating, right? Those things you need to do changes to your PAT to get your actual CFM. Third one is your change in working capital, which is not reflected on your P&L. Okay, these are the only three things you change to your cash flow from operations to get your actual cash flow from operations. Okay, right now, right? Okay, if I add other gains over here, other income, let us say I gained 500,000 from, let's say, selling of my asset. I did a profit of 500,000. Now then, which activity is this? Investing. So it's a gain, right? It's a gain. So my, my cash flow would have increased or decreased now. Since it's a gain, my cash flow would have increased or decreased? Would have increased. So how to then adjust this? How to adjust this? Then we add or subtract now. Subtract less other gains. Okay, other gains. What is that? Other gains was 50,000. Now see, it was a profit, so it ideal the impact is nothing. Impact is zero. Impact on the ideal last cash flow will be zero because something will get added over here, and then so this was less, na? So it will be subtracted. Sorry, less, and then it gets added over here. Profit from sale of assets. So ideally, there's no change, but right, we need to add it back over because it was a cash inflow. It's a profit, so cash inflow, right? And the balance sheet tallies. Okay. There was one. Everyone got? Everyone? Any doubts? Yeah, that's what I'm coming on. That part. See, I'm just taking just to show one thing to you guys. See what has actually happened. See, before adding interest, let us say I have not added interest as of now. Okay, I have not taken interest as of now. Okay. What was my cash flow from operations? Was 1.64. Okay, let me write it over here. It was 1.64. Okay, fine. Now what I'm doing is that I'm adding interest. Am I right? What I'm doing, I'm adding interest over here, means subtracting interest from over here and adding back again in the CFO. So should my CFO change? Means I will subtract from PAT and add back again over here. Should my CFO change? Should my CFO change? I'm subtracting from PAT and adding back over here. I'll subtract 1 million from PAT and add back over here. Should not change, right? It is one and the same thing only. What I'm doing is subtracting and adding back. There's no impact on the cash flows. You know what happens, but see what happens ideally. I do this, see what happens. it actually increased. You know, my CFO actually increased by 300,000. Yeah, good thing. I think your cash flow increase, na? Cash flow from operation increase. Very good. Automatically, Excel automatically increased 1.94. From 1.64 it became 1.94. You don't do anything in the operation. Your sales didn't increase. Your profit didn't increase. Your profit declined, but still your CFO increased. No? So good now, our company. So taking more debt, you know, if you take more debt, cash flow will increase more. But take 20 million of that example. See what happens. Wow, I'm a profit making company now. Should this work this way? Should this work this way? Taking more debt increases the cash flow from operations. Now, why is this happening? Now, for depreciation, recollect depreciation. When you add one expense, what happens to the other expense? When depreciation was added, what happened to tax? What happened to the tax rate? The tax amount? When one expense was increased, the other expenses reduces. So that other expenses reduces. That was a part of operations. That is why your tax reduced. So your tax reduced, so your cash flow from operation increased. Here also we did the same thing. Here also we did the same thing. That one expense increases, so obviously your tax rate decreased, right? And this tax rate led to an increase in your, you know, what are you doing? You're ideally subtracting only how much? That 2 million into 30%. That you're subtracting 2 million. I'm sorry. Ideally, you're subtracting how much? 2 million into 30%. 600,000 only you're subtracting. I mean, ideally, you have saved, right? 600,000 you saved. So you subtract ideally 1.4 only, and you add how much? You add the whole amount. Add 2 million, the whole amount. Should we do like this, or should we adjust something over here? Your cash, ideally, how much was your cash outflow? 2 million was an expense, but it saved also, right? 60 million was saved. 6 million was saved. So ideally, only 1.4 million went out. So when you add back, you should not add back the full 2 million, because that wasn't your cash outflow, because taxes was saved over here. So here, it should be always, interest rate should be always, whenever you add back, remember this, it should be always interest into 1 minus T. 1 minus T is your 1 minus tax rate. So whenever you add back interest, make sure is equal to, interest is equal to this into bracket 1 minus, now tax rate is already over here. We have already found our tax rate 30%, and then you close the bracket. Now you see it is 1.6 million only. Now whatever loan you take, whatever you do, your cash flow will remain same. Okay, because you don't have to add that much of interest cost, because interest, the effective interest rate actually decreases. You see, you don't pay actually 2 million, you only pay 1.4 million. And that is the reason, you know, people like Elon Musk, Mukesh Ambani, Adani, you know, they have a lot of debt. You know, they have a lot of debt on your books. You know why? It reduces their tax outflow. Yeah, to save tax. So now Elon Musk in US, the tax rate is 50%. So Elon Musk will rather prefer taking a loan at 3-4% and not paying that 50% tax. You know, Tesla's profit is negative. Almost they are loss-making company. Why? Because they are taking so much of loan to expand. Though he has money with him, He is the richest man in the world. Elon Musk don't have money, but still he doesn't use his own money. His money is invested somewhere. He is taking debt to invest. So what it saves on its profits. Recently Akshay Kumar made a statement saying that he was the highest taxpayer for the year. In India, he was the highest taxpayer. Who is the richest man in India? Who is the richest man in India? Adani and Ambani, right? Both. They should be the highest taxpayer, ideally. Right? Ideally, there should be the taxpayer. That is what it should be, right? But no, who is the taxpayer? Akshay Kumar. He is not, he doesn't even come in the richest list, a billionaires list. There are many people who are there in the list. But still now this business has this, when you do a business, you get this liberty to, now let's say I am not working, I'm not employed anywhere. I am doing a freelancing work. Now in this, whatever money I earn, whatever money I earn, I can take my expenses. First up, so I can take my expenses. Second up, see, even if I have money to buy a car, new car, I will not buy from my own amount, own money. See, let us say I want to have, example, I tell you, let's say I earn, let's say 1 million a year. Okay. I say that I earn 1 million a year. Okay. Now I have 1 million with me to take a 1 lakh to take a Z10 1 million card. Okay. I have this money in my bank account. But rather what I will do now, I will invest this money. So let us say 1 million, so I have 30% tax. So can I say I am paying a tax of how much now? This much. I'm paying almost 3 lakh rupees tax. Okay. Now what I do, so effectively I have 7 million. What will I do? I will invest this 7 million, let's say in stock market. Okay. I'll invest this 7 million, 700,000, 7 lakhs in the stock market. That might give me 10% return. Okay. On an average. Okay. Now here, then I will take a loan. Let's say I want to buy a car. I will not invest this car. Car you get an interest rate of let us say around 15% in stock market. Car rate is, let's say interest rate is 8 to 10%. Now I will take a loan of 8%. 7 lakh loan. Though I have money, I will not take. I will take a loan of 8%. So my interest cost will be how much? 56,000 is my interest cost per year. Now, then what will be my tax rate now? 56,000. Now my profit is how much? My profit is this much. And then I will pay a tax on not this amount. I will pay a tax on this amount. What was my earlier tax? 3 lakh. 3 lakh was my tax. How much I saved? I saved almost 16,000 rupees in this tax amount. 16,000 I saved, and though I want to purchase, I would have gone and easily purchased. Am I right? So can I say I can save 16,000 for the year of the loan I have? Let's say I have a 10-year loan. I say I will save 16,000 every year. Am I right? Plus I am earning 10,000, 1 lakh over year. That is a different thing. That is not countable only over year. I will save 16,000 for next 12 years because there's a 10 years. Because I've taken a 10 years. So 1,67,000 I will save over here. Plus this year, if I'm earning 1 lakh, I will earn how much for 10 years. You see how much I have earned, saved from that 7 million, 7 lakh. I have earned almost 12 lakhs. Saved 1,68,000 and saved this. How sensible was this? Not using my own money to buy a car. Let's say 10%. Even if I take 10%, it's fine. I'm not taking 15% because it was too hard. still on 7 lakhs, I have actually earned more and I already own a car. Can I say virtually my car was then free? Can I say this? In 10 years, my car was virtually free. You see? Virtually, I didn't pay only to buy my car. Now think these numbers are in millions. This is in 10 lakhs. What if are these numbers in crores? You know, revenues for Ambani and Adani are in billions. See how much they saved on just this tax and taking this loan. So more the loan, more happy I am. The more loan that I get, the more happy I am. Though it can be risky at times, what if I lose money, but I know that I will make certain amount of money in a year and I'm capable of paying this interest. Virtually I am making my car interest free plus I am earning more money on it. So this is how the finance works. This is how rich people make money. We take loans to buy buy liabilities. We take loans to buy a house. That doesn't give you any money. We have to invest in returns giving asset. If you take a loan, do a business. Don't take a house. Rather than take a commercial, take a shop and start doing business. Now you get loans at 10 to 15%. If you can earn more than 15%, you will have 2 houses after 10, 15 years. So this is how the interest rate works. So interest actually saves your taxes, and this should not impact your cash flow from operations. So this is one of the adjustment that you need to do in your cash flow statement. Fine, got it? We'll talk about interest later on again. How does that impact? How does that, Rich Dad Poor Dad book, if you have learned, if you have seen, they have given a lot of examples like this. Why should you have debt? Having debt is not a bad thing. Adani has 4 times debt from what he has. If he has 100 crores, he has taken a debt of 400 crores. And is saving billions of rupees in taxes, crores of rupees in taxes. That no one sees. Because everyone sees that Adani has so much of debt, so much of debt, so much of debt. Okay. As long as he is capable of repaying that debt, he is good enough to do the business. Okay. So I will give one work. Today is 19th November. Give some. I will not give that. This was my assumption, right? This was for FY21. Now you try to do it for FY22. Okay. You try to do this estimated. I give you numbers. Okay. Equity raised 10 million. Okay. This is raised again. The raised amount. I hope you have the schedules. Equity raised 10 million. Purchase of PP. Let's say 900,000. Okay. Useful life. Let's say 20. Now COGS. No, don't work on the hero model. Is it that you want to work on hero model? It should be better. Okay, those who understand, do it. Okay, rest all it's fine. Try to do it. I have given the assumptions. Okay, try to make this assumption is only you should take that like this. Okay, for cost of goods sold. Rest all this is increased. So your revenue is increased, employee cost is increased, other expenses as a percentage of sales. Then you get EBITDA. You will get, where will you get depreciation from? Where will you get depreciation from? Yeah, you will get it from PP. So I have made a fixed asset schedule over here. I will do it, make this color. Okay. These are the sheets that you need to update. Okay. Tab color. I'm doing it red. These are the sheets that you need to update. Other equity also I have given. The other equity closing I have given. Okay. You have to start with opening. You don't have to do for this year. To start with opening. And then I have also given dividend per share and dividend payout. So you will get your debt schedule also I have given. Repayment. I have given 2, okay, short term and long term. So in the cash flows, you need to add short term as well as long term. This is addition, this is repayment. And working capital,
Working capital has not given. Once again, working capital also I will give you. Inventory is just update this, okay? Table is 51, okay? And these are the days, okay? Now I have already focused. Now this you will focus, right? The payments will be this will be purchases. The purchases will be sales. Purchases are sales. Okay. You can take directly from here on. Okay, sales. And I have given you assumptions for 20, okay, 28 days, 33 days, and payables will be 67 days. Okay. These are the assumptions for next year. Can you find? You will get the sales from when you forecast. Okay. You get the sales from where you forecast. Punch number, this receivables you will find from your formulas. Okay. So these are the 4 schedules that you need to make. Okay. I have done it. Okay. The 4 schedules you make. And so no inventories. Inventory we have to. So IT sector there will be no inventories. Specifically service sector. The cash flow statement, see there are all other items. You don't need to do anything over here. Only change item which you know. So I have marked in yellow. These are the only item you need to change. Don't do anything. Don't take it or copy paste over here. Okay. Don't do anything over here. This should be all blank. All the numbers which are irrelevant should be blank. Only your few numbers will change. Here what will change? Trade receivables will change. Inventories will change, right? And then your payables will change. Payables, this will change. Don't do any other changes. Now make sure you know, now there's no taxes also. Taxes you don't have to pay because profit is already over here. So you don't have to also change. Only this, what I have marked in yellow, these are the only items which you need to change. And then automatically everything will come. At least you know how to do it. Opening and closing. Now make sure whatever you do, the financing activities should match. So I have done it only. This should also be like some. Just skip and okay. You have to just punch the numbers. Numbers will come automatically over here. And then what you do is when you go to balance sheet, see I have already given 21 is there. I have just clone for 22, copy pasted here also. Only those asset schedules that you made, you have to change. You know, asset schedule will change, cash will change, your inventories will change, your trade receivables will change, and your payables will change. Borrowings will also change, and your trade payables will change. These are the only items which will change, and automatically the number should tally. Don't change any other numbers over here. Okay. Try doing it. I will do with you again next class. Okay. Fine.
Just one, a few words from my side. Why you guys are not doing your assignments?
I think many of them have done. So next class, now Samitra, you before the class, just let me know.
They are not submitting it. Friends, what are you doing? Like I have received only 2 or 3 assignments. So what's going on? Please submit your assignments personally to me. I'm the person who has shared the joining link. Sir, did they do the assignment properly?
Many of them have done it. Many of them have done it.
Okay, then there was an issue with the submission. So please submit it to me, okay? Because I'm the person who is going to give you the certificate. So please make sure you submit all your weekly assignments every week. Like if you have your session on Saturday from 3 to 5, make sure you submit your assignments at least by 1 o'clock in the afternoon by Saturday, okay? So इतना please कीजिए. नहीं तो मुझे लग रहा था कि आप लोगों ने कुछ किया ही नहीं. I was so like hesitant about it. Only 3 or 4 assignments I have max to max. I have noticed 3 assignments only. तो सिर्फ 3 जन का मुझे मिला है. बाकी लोग भी please submit कीजिए, ठीक है? If you do not do it, if I lose a track of it, I will again ask you to do the second week's assignment, third week's assignment like that. So please make sure you have submitted your assignments. Otherwise, at the end, it is going to create trouble for both of us. So please do it, and please make sure you do the assignments. इसके बिना कुछ नहीं होगा, right? We have already told you about it. So please अच्छे से कीजिए. इतना कुछ आज सर ने सिखाया. I was also there for some time. So please do it. Okay. Basic Excel wala, you can just skip those kind of things. Okay, those are not even counted under the main financial modeling thing. Excel lessons are given. Those who do not know it at all, for them only it was given. You please, like, whatever your mentor Rishabh sir, he is teaching you, you focus on those things particularly. Okay, वो सबसे ज्यादा important है. वो मैंने जो Excel के lessons share किए थे वो कुछ भी नहीं है. वो बस लाइक बहुत ही बेसिक सा चीज है. उसको आप छोड़ भी दीजिए चलेगा. बट फाइनेंशियल मॉडलिंग सर ने जो फर्स्ट सेशन से जो कुछ भी सर ने सिखाया है A to Z, प्लीज उसको कीजिए, ठीक है? उसके बिना कुछ नहीं होगा. और वही चीज है फाइनेंशियल मॉडलिंग जो कि आपके इक्विटी रिसर्च में काम आएगा, फाइनेंशियल एनालिस्ट में काम आएगा, IB में, इन्वेस्टमेंट बैंकिंग में काम आएगा, प्राइवेट इक्विटी में काम आएगा, हर एक कोर फाइनेंस के फील्ड में यही काम में आएगा.
Soumitra, one second. There was just a update for you guys. There was one student from last batch. She got into equity, equity. That is a Moody's, because of this. She messaged me on LinkedIn saying that she got an opportunity to work in equity just because of modeling. Whatever we have taught, she got an opportunity. That is, equity is a big MNC name. Moody's. It was a part of Moody's. So
आपको शेयर भी कर रहे थे, right, on LinkedIn about Equity Knowledge Partner, that ma'am, she is the HR, right?
Right.
Yeah, I have been also sharing that recently in the group.
Okay.
So
She got, so one student got, so she did it all her homework and she got it. So be consistent about that. So Soumitra, actually we had last class also have told that we make a list, those who have sent and those who are not doing it now, we won't take in the class, because now what happens, जिनको सीखना है seriously वो लोग इधर डाउट पूछते हैं, बट जो बाकी जो करते नहीं है उनको फटाफट कोई तो डाउट आ जाते हैं बीच में से, हम लोग पूछते रहते हैं, बाकी लोग का भी टाइम वेस्ट करते हैं. It's better we make a list ना next time and you send me, so I will देखते हैं कौन किस को एंट्री देना है, किस को नहीं देना.
Otherwise it becomes very difficult. Like why should we be wasting our time again and again on the same thing?
No, but others who are doing उसके लिए भी जो दूसरे लोग बना रहे हैं उनको भी होना चाहिए ना थोड़ा. जो लोग अच्छे से मेहनत करके बना रहे हैं उनको अगर कुछ एडिशनल डाउट हो तो पूछे. ये वापस पहले का ही डाउट पूछते हैं फर्स्ट लेक्चर का कि सर वो कैसे आता है, ये कैसे आता है.
वही तो प्रॉब्लम है. अगर आपके एग्जाम के चलते अगर ये हो रहा है एक हफ्ता, ठीक है, यू कैन इन्फॉर्म अस बिफोर हैंड, ठीक है, मान लेंगे उसको. बट एवरी डे वी कैन नॉट डू इट, राइट? आप आके दूसरे क्लास